Hi, I'm Ross Maynard. Welcome to this short quick insight video on the new European Union Sustainability Reporting Rules. A few weeks ago I delivered a webinar on the new IFRS Sustainability Reporting Standards, IFRS S1 and S2, which come into effect from January 2024 for corporate reports published from 2025. These new European Union sustainability reporting rules are very much in alignment with the new IFRS standards. If you're based in Europe or work for a company with a European headquarters, then these new rules are likely to apply to you as well as the new IFRS standards. The European Commission has enacted the European Sustainability Reporting Standards, ESRS, for use by all companies subject to the Corporate Sustainability Reporting Directive, CSRD. Like IFRS S1 and S2, the ESRS comes into force in January 2024. Let me outline the framework for these new reporting standards. The European Corporate Sustainability Reporting Directive, CSRD, came into force in January 2023 and relates to the social and environmental information that companies have to report in their annual return. Small and medium-sized enterprises that are listed on a stock exchange also have to report. Essentially, CSRD is a framework into which specific reporting standards will fit. CSRD requires companies to use recognised standards to fulfil their sustainability reporting obligations, and the European Commission is working through a process of defining the common standards which will fit into the CSRD reporting requirements. The new European Sustainability Reporting Standards, ESRS, have now been defined as the sustainability reporting requirements that will apply to meet the requirements of CSRD. The European Sustainability Reporting Standards and CSRD apply to all large organisations operating within the European Union, as well as all companies with a stock market listing in the EU. Their aim is to help investors, civil society organisations, consumers and other stakeholders to evaluate the sustainability performance of companies. The European Union has created ESRS to reduce corporate reporting costs by ensuring common standards apply across jurisdictions. There are 12 areas against which companies have to report under ESRS. These are general reporting requirements, general disclosure requirements, climate, pollution, water and marine resources, biodiversity and ecosystems, resource use and the circular economy, workforce, workers in the value chain, affected communities, consumers and end users, and business conduct. On first inspection, the areas covered by ESRS seem vast, but in fact they are largely the same as the IFRS S1 and S2 requirements, but specified in more detail. In addition, companies only have to report relevant information and may omit the areas which are not relevant to their business model or activity. For example, a company not impacting the marine environment will not have to report against that area. Having said that, if a company chooses to ignore an area of the standards, it must explain its reasoning in detail, and its auditors will have to verify its rationale. Although I mentioned that these new EU sustainability reporting rules come into force from January 2024, there is in fact a phasing in for smaller organisations. Companies with less than 750 employees have 1 to 2 years to develop their reporting, depending on the topic. In addition, the ESRS reporting requirements will not apply to SMEs listed on the stock exchange until 2026. Also, some of the data requirements identified in ESRS are voluntary rather than mandatory, for example those relating to the self-employed or agency workers. Overall, however, it seems that sustainability reporting requirements within the member states of the European Union will get more rigorous over time. The EU is also developing simpler sustainability reporting standards for small and medium-sized enterprises which are not listed on a stock exchange. The aim of the European Sustainability Reporting Standards is to avoid multiple layers of sustainability reporting for multinational organisations. The European Union has developed ESRS to align with the new IFRS Sustainability Reporting Standards, IFRS S1 and S2, and the Global Reporting Initiative. Information reported under ESRS will meet the requirements of IFRS S1 and S2 if a company is also required to report under the IFRS standards. Therefore, such companies will not be subject to double work. It's noticeable that the ESRS standards go further than IFRS S1 and S2. While the new IFRS standards currently focus on how social and environmental issues create financial risks and opportunities for the company, the ESRS requirements cover a broader range of impacts on people and the environment, not just financial risks to the company. Those who work for organisations that may be affected by these new European standards will require more detailed information than I can give in this short video. The two most useful sources of further information are as follows. The European Financial Reporting Advisory Group, EFRAG, is an independent advisory body funded by the EU. It developed the ESRS standards and is responsible for developing guidance and interpretation resources. Their website is at www.efrag.org. There is also information available from the European Commission website, for example on the ESRS at the link shown. Let me move on now to the Global Reporting Initiative, GRI. The Global Reporting Initiative is an independent international organisation headquartered in Amsterdam which publishes widely recognised sustainability reporting standards. The GRI has offices in New York, Latin America, Africa, South Asia and China, and their website is www.globalreporting.org. The GRI reporting standards are voluntary and enable any organisation, large or small, private or public, to understand and report on their impacts on the economy, environment and people in a comparable and credible way, thereby increasing transparency on their contribution to sustainable development. There is an array of interlocking standards which organisations can choose to use. Some of these are sector-specific, for example for the oil and gas industry, while others relate to specific sustainability topics, including anti-corruption, water and effluent, employment and labour practices, impacts on local communities, and so on. I mentioned that the GRI standards are voluntary. However, the GRI signed a partnership agreement with the IFRS Foundation in March 2022 to facilitate joint working. The new Sustainability Reporting Standards, IFRS S1 and S2, have been developed to align with the GRI standards. Similarly, as I noted earlier, the new European Union European Sustainability Reporting Standards also align with the GRI standards. Thus, GRI's work is influencing mandatory reporting requirements across the world. And in the future, it seems likely that worldwide environmental, social and governance reporting standards will develop alongside each other to simplify reporting requirements, but also to ensure that an organisation's impacts are reported equally thoroughly wherever they are based. I finished this Quick Insights video with a mention of the new carbon credits benchmark issued by the Integrity Council for the Voluntary Carbon Market, ICVCM. The ICVCM provides governance for the voluntary carbon market. The carbon credit market is worth around $2 billion per year, but has faced reputational issues, with reports questioning the effectiveness of some carbon projects at removing greenhouse gases from the atmosphere. Some projects have been shown to be very poorly managed. As a result, companies have moved away from carbon offsetting, and the International Standard on Carbon Neutrality, PAS 2060, discourages carbon offsetting as a means of meeting carbon neutrality, except as a temporary measure. As a result, the ICVCM have developed a framework to assess the efficiency and effectiveness of carbon reduction projects. Carbon credit programs can now apply for assessment against this new benchmark. No approved programs have yet been announced, although awards are expected to be made by the end of 2023. The aim is to enhance the reputation of genuine carbon offsetters, while squeezing sham providers out of the market. Samuel Gill, president and co-founder of the carbon data provider Silvera, said, "When it comes down to it, most carbon market participants want to maximize impact, and setting a threshold for credit integrity should be a boon to developers funding projects and for buyers seeking high-quality investments." The United Nations Framework Convention on Climate Change, COP28, in November 2023, is expected to call for a scaling up of high-integrity carbon markets, and the new standard will facilitate that. In summary then, the European Union is implementing new sustainability reporting requirements, called the European Sustainability Reporting Standards, from January 2024. These align with the new IFRS Sustainability Reporting Standards, IFRS S1 and S2, but go into more detail in some areas. They will apply to companies operating in the European Union or listed on stock markets in the European Union. They will be phased in for smaller companies. At the same time, the Global Reporting Initiative is working closely with standards bodies, including the IFRS and European Union, to ensure that sustainability reporting becomes more effective across the world. And a new carbon offsetting standard is being launched to improve the integrity of the carbon credits market. I hope you found this Quick Insights video useful. I'm Ross Maynard, and I hope you will join me for some other of my videos and courses. Goodbye.